Good morning, everybody. Mike Tedeschi over at Perspective Wealth Planning. We have a lot to cover in today's video. Obviously, the market has been making historic moves pretty much on a daily basis. In this video, I don't want to get all doom and gloom. We will look at some of the negative factors in the beginning here, and we have seen an absolute historic fall from the top, especially not just in terms of size, but also in terms of velocity. But that being said, there are a number of hopeful signs technically in the market, some important key support levels, also some incredible sentiment readings. So we're going to take a look at those, and we're going to see if we can't find a little bit of silver lining in the midst of all this carnage. What we have here is the S&P 500. I'm going to back this up, but I'm going to look at this in on a monthly chart. Now, one of the things I like to take a look at is Fib Retracements. So after a big move in one direction, you can take a look at Fib levels to see a retracement of the previous move. And the levels I like to pay close attention to are that 38.250 and that 61.8 level. A lot of times the market will find support on a move back after a large move forward at one of these three levels. And the interesting thing to note, the 38.2 Fib retracement level lines up with exactly where we are currently at right now, and it was also basically the low from December of 2018. So this right here is a key level where we could legitimately see a technical bounce from. We look at this in here on a daily basis and we zoom in a bit, right? We can see here's those December 2018 lows. Here's the action we had yesterday. We actually broke below it, but the market was able to bounce back up and close above it. This morning, I'm putting this together Thursday morning. The futures are down about 2.5% once again, putting the S&P 500 at about 2350, which is right there on that level. So that's the level I'm going to be paying very close attention to over the next day or two to see if that is a level that does ultimately hold. We'll back this out again onto this monthly chart. The next area of important support on the Fib retrace is that 50, and it's right there at that 2000 level. Now, I'm going to take this off of the screen, and we're going to just look at our horizontal support and resistance levels. All right. Without using fibs, we still get an important level right here from the December 18 lows, and that's where we're at right now. And then we have this whole area right here, in my opinion, is a support zone. All right, we spent a number of years inside this range, essentially basing before that big breakout, back test, and then continuation forward. So if this level here doesn't hold, I am looking at this whole zone right here as that next support area. All right, this is where we had a ton of price action back in 2014, 15, and 16. Right, so there's price always has a memory, and there's a lot of memory in this zone right here. Underneath that, if we were to go underneath of that, we would have our next level all the way back down from the highs from 2000, the highs from 2007. But let's see how we react inside this zone, and that's assuming, of course, that we actually do lose 2018 lows. So from a technical perspective, we had a horrible sell-off so far, but we are sitting above some key levels in terms of support here. So we're going to continue to pay attention to that, but we could be at a situation here where we have another 5-10% to the downside before we get to a major support level. And when I show you some of the sentiment information later on, you'll also see that tracking one of the previous sell-offs, we're actually about that far away from matching that particular setup. Speaking of sentiment, let's take a look at the dumb money, smart money confidence. All right, take a look in here. We are now extreme in the opposite direction, right? We talked about this a long time, right? When the extreme happens, we ultimately close that gap. Right, it doesn't mean it happens overnight, but eventually it will happen. We'll look at what we've got now. We've got that huge split the other direction, right? So smart money is extremely confident. Dumb money is extremely fearful at this point in time. One of the lowest readings I've ever seen on that right there at 10%. So we're getting to a sentiment extreme here, right? We could still head a little bit lower, but historically, this level of extreme is one where we would think that we would start to close that gap at some point here in the near future, right? Now, as we've seen with the size of the moves, right? If we're wrong by 2 days, that could be another 15% on the S&P. So we need to pay very close attention to what this is right now. But be cognizant that we definitely are set up at a spot from a sentiment reading where we might be nearing, again, that kind of technical turnaround point. Now, one of the things that has really concerned investors here over the last couple of weeks is the central bank and government have made major financial steps to try to stem the flow of what is going on. We have lowered interest rates, 2 emergency cuts back to 0%, 0 to a quarter percent out of the Fed. We have put trillions of dollars into the market in repo purchases. The central bank said that they were going to step in and buy corporate paper. They're now bailing out the money market area. They're putting in $1 trillion overnight in repos. We have lowered the bank's reserve requirements to 0%. And every time they've announced one of these major stimulus components, the market maybe makes a bounce of a couple of percent and then continues to just head lower. So the central bank intervention is not working, or at least that's what it looks like. Now, the reason why I wanted to bring this up is 2008, from a central bank intervention standpoint, is the closest to what this particular crisis is. And when we look at the information that the Fed put out trying to stem the flow, every single time they did something, the market still dropped a little bit further. It took a while for the market to actually digest and actually like the information. Let me show you. In here, you can see all the different things. We have an Economic Stimulus Act was introduced. Up here, it was passed. Then you had the Primary Dealer Credit Facility funding facility. It was passed, and the CPFF, which was the Commercial Paper Funding Facility, which we've just turned back on again, as I said earlier. It was introduced. It became operational. Then we look at the American Recovery and Relief Act. The Fed rates to 0. Then the Fed Fund, the American Recovery and Reinvestment Act of 2009 was introduced, and then it was passed, and we still continue to drop for a bit. So you can see all of the central bank intervention, and the market just continued to slide lower during it. So while it feels like everything that the Fed is doing, the market's just shrugging off, it did that last time as well, but eventually all of those tools were what was necessary, and it did pull us out of that recession. And if we look at all the data points, from when these things were passed to how much they drew down ultimately, you can see those numbers were really huge. The market still continued to fall, and then as we went out 3 and 6 months later, we started to see things really start to turn around, so to speak. So this is really important to keep in mind, guys, that even though the Fed is doing all of these things, and if you're watching the day-to-day market, it doesn't look like it's doing anything. This is going to take a little while for that capital to flow through the economy, for it to shape investors' confidence, and really that's what needs to happen. The confidence needs to come back to this market, and we're still not there, because what we're facing, if you look at the timeline, we're still probably a few weeks out, maybe six plus weeks out from the peak of what ultimately the coronavirus is going to be. So there's still a lot of fear and a lot of concern in the market. So again, this might be something that ultimately does work for us, but it may take a little while for it to. Now, I had said that we were going to take a look at one of the previous crashes and how we're tracking against it. So let's talk about that. Now, in order to shape our current market conditions to match 1929, we did have to slow down the rate of descent by half. All right, and that's really important, because we've never seen any sort of selling that happens this quickly. And I think that this is honestly a fair assessment that Jason did over at Sentiment Trader, because I do believe that everything happens quicker in today's world than it did 10, 20, 50 years ago. Technology has really made a big change. So we're watching what would have taken months to play out happen in weeks, right? And if we go back to 2018, we had that huge sell-off right at the end of the year, and the thing was over within a couple of weeks. I mean, that V-shaped rally and recovery happened so fast. So anyways, if we do take a look at tracking this by slowing down what's currently going on, we're tracking what happened in 1929 very, very closely. And if you look, we're close to one bounce, then one more rollover, and then that slow, steady grind higher. That's how it played out in 1929. Is that what's going to happen here? Not necessarily, right? We can't look back at this and go, that's exactly what happened, so here's what's going to happen now. It's the only thing that's even somewhat remotely close to what we're currently facing, and I figured that's why I would ultimately share it. Basically, we have the stimulus and the central bank intervention of 2008, and we're following the trajectory of 1929 because if this virus does play out the way that it looks like there's a good chance that it will. We're talking about high unemployment rate that would or could match the Great Depression in the 1920s, and that's the reason why the central banks are trying to do everything that they can. They also talked about giving Americans money directly to try to stem the flow of panic and concern in the overall market, because even though companies like some of the automotive companies right now, they're offering 7-year interest-free loans, and they'll pay the first 4 months for you, so no payments for 4 months, 7 years, 0%. Still, who's going out of their house to risk getting sick to buy a car? It's not a lot of people. So as enticing as companies can make their products at this point in time, people are still hunkering down and very concerned. So the solution that they're trying to put through now is to actually put money directly in people's pockets, so they don't have to worry about work. They can pay their rent, they can get food, to try to slow this thing down for another couple of months. There's two other things that I want to take a look at here in today's, three things. I want to start with oil. The collapse that we've seen in oil here is historic. Saudi Arabia, in the middle of all of this crisis, decided they wanted to flood the market to try to drive OPEC out of business. We are now trading underneath of those lows from 2016, and we're trading underneath the lows from the 2008 recession. Yesterday, oil actually hit $20 a barrel. The lowest price point in the last 20 years is $17.12, and we're just a stone's throw away from that happening. So this is a pretty historic move out of oil, and regardless of the central bank intervention, if the price of oil doesn't come back up, all right, even if we get through this coronavirus thing here over the next couple of months, we have a ton of oil and gas companies in this country that lose money at oil at this price. This is going to be a huge detriment to the energy sector for a while, unless the price of oil can get back up over that $30 a barrel, and pretty quickly. If we look at oil today, oil is up 7.5% from yesterday, and you can barely see it on the chart. That's how dramatic of a sell-off we have seen there in oil. Almost 70% in a month and a half. The next thing I wanted to take a look at was bonds. Right, bonds have made an explosive move higher. When we look at the 30-year treasury bonds, look at the monthly candle that's on this. This very easily could have been a potential blow-off top. The move that we saw out of the 30-year bonds in a couple of weeks was the average size move that it would normally made in the course of a year. So a really explosive move to the upside. And even as the Fed continued to lower rates, we noticed the bonds that did not continue to rise. So the market may have over-expected rates to continue to go down, and essentially everybody tried to pile into what they thought was safe, which caused a big explosion in terms of the treasury bonds, which subsequently hasn't held. Now, as things calm down, that may turn around, but the other area that we look at as a safe haven a lot of times in crisis, gold has completely collapsed here over the last 2 weeks, along with the rest of the market. It's given back basically all of the moves that it had since November, and is actually down on the year as well. Now, it's not down nearly as much as stocks are. It's down 4% or something like that. But at one point, it was up 10% for the year. And what has happened here is, even in the flight to safety of, you would think of gold as kind of being that safe mechanism, everything gets thrown out in a sell-off like this. People have to raise cash, and they sell everything kind of indiscriminately. The same thing happened in 2008 out of gold prices as well, and that's why I wanted to bring this up. as well for you guys. If we go back right in here, you'll notice that gold in the beginning of that crisis actually dropped 30% in a month. And then it proceeded to make a move of 200% higher over the next few years, right? It was not immune to selling there in the beginning of that crisis. But you'll notice here we are in October of 2008. Gold has started to make the bottom. And if we go back and we take a look at where that stock market is in October of 2008 is right here, it still drops another 40%, whereas gold starts to make that turnaround. So anybody that's watching the precious metal markets wondering what is going on, everything got thrown out together here in the beginning of this sell-off. Now, gold could continue to go lower. There's no guarantee that this is a flight to safety at all, but we would expect, looking back over the course of history, that it would tend to recover once the panic selling stops quicker than stocks, at least in the beginning of that turning point. So it's worth paying attention to. As always, guys, I hope you guys have yourself a fantastic week. I'll see you all next week. Stay safe out there. If you guys have any questions and you want to talk about anything, feel free to give us a call. You can reach me at 814-580-9881, or you can shoot me an email to mtedeschi@Perspective Wealth Planning. I'd be more than happy to sit down and discuss the current conditions of the market and what that might mean for you personally. Look forward to hearing